Hi, Matt McAleer, Cumberland Advisors, September 1st, just before the close. Labor Day weekend, maybe we're cheating a little bit. Anyway, little bid to the markets this week. Remember last week we looked at some charts, we looked at some momentum charts, and they were mildly oversold. In a perfect world, maybe they would have gotten a little more oversold in terms of a more opportune entry, but we'll see. I think what we're looking at here, and may continue to look at, is some back and forth chop. Remember, there's an awful lot to be gained and to be said in terms of media predictions, going on different channels and saying, I'm looking for the market to drop 15%. We're looking for the market to rip. Market's going higher. What if the market's just chopping? That's what it does most of the time, by the way. Chop, 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 move. Chop, 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 move. Either direction. In terms of what we're looking at, I thought it was interesting that even in this mild weakness over the last 4 weeks, and that's what it was, let's say August, we're looking at the S&P down about 1.5%. In this mild weakness, I found it interesting that the defensive sectors couldn't get a bid. We talk about correlation a lot on these videos, and we haven't spoken about it in a little while. But what we like to do is take a peek at cross sectors, cross assets, analyze how things are working in a full trading spectrum. Well, if markets were in trouble, not deep trouble, but just trouble, you would expect utilities to get a bid. You would expect consumer staples to get a bid. You would expect perhaps gold to get a bid. You would certainly expect treasuries to get a bid. And when I say bid, I mean bought. We haven't really seen that, right? Staples, utilities, weak August, very weak in the face of weak broad markets. So if you are a bull, if you think the market is going higher, you take that as a positive. If you're negative on the market, you're scratching your head a little bit. You would have liked to see defensive names show a little more strength. Just one of the things we look at week to week. In terms of interest rates, and they're important for equities. Sometimes people think of them as different asset classes, and while they are from a security standpoint, they certainly influence each other. Short-term rates at 5% are very attractive. And it allows you as a trader or an investor to really wait to see your pitch. If you don't get your pitch, fine. Market goes higher and make money. But in terms of where we were 18 months ago, 24 months ago, 36 months ago, when you were in cash earning 0.25% is very, very different than being in cash and getting paid. So while in the long term, 4 or 5% return on cash can get eaten up by inflation. Shorter term, decent parking spot. In terms of what we'll be looking at next week, did this week's weakness in yields or strength in bonds, did that give an opening to the equity market getting some legs over the next 2 or 3 weeks? Maybe. One thing's for sure, if I hear one more analyst say September is traditionally a weak month, we all know that. Stop trading on things that everybody knows. It would be surprising here if the market actually bottomed in August and had a good September, right? Keep flexible, keep an open mind, have levels that you want to get involved in, and keep an eye on what sectors worked best in the soft August pullback. My eye was on industrials. We added that to the tactical account. May have to get a little larger and will get larger in that space in any further pullback. So let's see what September brings. Next, the Moose.
Hi, it's John Mousseau. I am the CEO of Cumberland Advisors, and it is Friday afternoon around 2 o'clock. This week in bonds, we saw bond yields move down, 10-year move down, basically the 2-year move down, 2 years more than the 10-year. The yield curve has started to steepen. It is starting this movement because the markets believe the Fed is closer to the end than they were of continuing to raise short-term rates. We had a number today, the jobs number. Even though bonds backed off a little bit based on the ISM prices paid number later on today, the big number is the jobs number, and though it showed an increase in jobs created, 187 when they were 1,000 when they were expecting 170,000. Last month was revised down, and we did see a pickup in the labor participation rate and more people entering the labor force. And we think that's a very good sign that wages should stay under control as you go forward. What's really interesting is if you go back just a few weeks ago, those 2-year and 10-year bond numbers were elevated much higher. So we've seen some reversion to the mean over the last couple of weeks, and yields have started to come down a little more relaxed. Muni yields actually lower on the week as well. You're seeing deals get priced cheaply, multiple times oversubscribed. That's a very good sign for the municipal bond market, particularly as you move into the fall. We know last fall was a very rough time for the municipal bond market. And why was that? Because we saw unprecedented amount of bond fund liquidations last year. And of course, as those funds had to put bonds on the market for sale to meet the redemptions, the market got overwhelmed and yields rose, and they rose at an increasing rate. And that's where you were by the time you got to basically last November. We think this year is a little different. We're seeing movements of bond money into bond funds, certainly into bond ETFs. And I think there's a recognition out there on the investing community that you're closer to the end of the Fed's hiking cycle, certainly than you were just a few months ago. And that, of course, gives people more comfort and the ability to commit more money into not only municipal bonds, but bonds in general. So we think that the bond market is really in this kind of paradigm of 2 steps forward, maybe 1 step back, because there's a lot of information to go through. Next week, we're going to have the same number of durable goods, jobless claims, etc. The real numbers will come the week after that, and that, of course, will be the CPI numbers and the PPI numbers. And it will be important to make sure that those continue to be well behaved. They might be a bit of a pickup versus what was a year ago, those base effects we've talked about. However, the real story is that do those 3-month and 6-month annualized numbers continue to ratchet down? Because even if the Fed decided to pause, they would have no compunction about raising rates again if they thought that was getting out of control. So something we're going to watch. We do think that bond yields offer great returns when you look at them on the fact that the real yields are now positive. You didn't have that for a long time. So we're pretty constructive from that standpoint. We hope everybody has a great Labor Day weekend, and we'll talk to you next week. Thanks a lot.
Thank you, John. Happy Labor Day, everybody. We will see you next Friday.